Thank you all for coming. I'm just curious, how many of you are hearing or are attending a Norris Group event for the first time of any kind? Wow, that's a big percentage. Okay, then I guess I'll just give a little background. What we've been up to for those 35 years is started at buying and selling homes. So we did that exclusively for the first 15 years. In the last 20 years, we've been involved in making loans to other investors and teaching them what to do. Along the way, we got pretty good at seeing what's next in the California market. The desire to do that came from something that happened to me in June of 1995. My son Aaron graduated from high school. I bought him a Honda Civic for $15,700, and the only reason I remember that is 2 days later I bought a 3-bedroom house in Riverside for $13,300. And it scared me because I thought, how could you have a real estate market that was so good in 88 and 89? 5 years later, you buy a house for $13,000 that rents for $500, and you had no competition at all. It was on a public list, and it just sat there, and I was the only bidder. And it just shook me up, and I thought, you know what? I've been doing this for 15 years, and I have no idea why things change. I don't know why these cycles occur, and I wanted to get to the bottom of it. And so I spent the next 18 months studying the cycle of California and came up with some answers. And we wrote a report in January of '97 called The California Comeback, Why Prices Will Double in the Next 8 Years. And turned out that was conservative. They tripled. And because they tripled, guess what? We were going to give some of it back. And in 2006, we wrote The California Crash, Why Prices Could Go Down by Half, foreclosures go up thousands of %. So how many of you guys got your copy of that? Some of you did. Probably most of you wish you had. I was part of the downturn of 1990, and I had no idea it was coming, and that was no fun. I did extremely well up until 1989. I built 7 custom homes in 1989, got done with them in 1990, and continued to own them for quite some time because no one wanted them. And I didn't know that would happen. I didn't know that could happen, but it did. And so that made me wary of just being confident that, oh, real estate always does well. It doesn't, and sometimes you have to know when those things change. We're going to talk today a little bit about the charts that we see right now. One of the things, and I'll just say a little bit of the methodology that we tried to do, is the hardest thing when you're trying to figure out something is to set aside your things you're sure of already. And one of those things would be interest rates. So interest rates moving up, in my mind, was always going to be detrimental to real estate prices. And then you get an interest rate chart and you put it next to a price chart, and you find out that's not true. And you go, oh my gosh, I wonder how many times I've assumed something that isn't true. This is a chart that we think is pretty important called California Affordability. How you figure this is you take a 20% down payment, so the median price of California is about $530. 20% down would leave you a certain loan balance, then you apply the going interest rate, you get a payment. What percentage of the households of California can get a yes answer from a lender and afford the payment? That's affordability. So, interesting question. The more affordable California real estate is, would that mean California real estate would do better when it's most affordable? Does that make sense? Yeah. What if that wasn't true? And it isn't true. And that's why I like charts, because if you'll sit back and let the charts speak to you, they're very educational. So we just went through some really exciting times, 2009, 10, 11, and 12. How high is the affordability? Is it like record high? Would you consider that a good time for California real estate? Or it stunk? It stunk. Prices went down by half. High affordability doesn't mean a thing. It means, yeah, your stuff's on sale, but guess what? Oddly enough, when it's on sale, most people don't want it. You usually have lousy sales years when you have extremely high affordability because we just lost money on that stuff. So when affordability goes down, it means that we're getting confirmed. Everything we bought went up. We're pretty excited about it, and we're going to do it some more. And we're going to do it some more and some more until there's a breaking point, and that's what this chart kind of tells you. There's a breaking point somewhere around 17% affordability in California, where you're so excited that you own it, and your neighbor, have you ever had this experience when we have a boom, you go in to get your hair cut? This happened to me 3 times in 1 year, and the person that cut my hair retired because they were being a real estate investor. Everybody starts doing it. That's when you know, guess what? It's about over. And so in 2005, we hit that. 89, we hit it. 80. So this chart tells me I'm going to get concerned about us reaching a peak. The reason I went on so much is we're now at about 31% affordability in California. As a real estate investor, that doesn't concern me at all. That is not a number that's remotely close to 17%. There's another thing that happens when you have affordability. When you get to that affordability breaking point, it's usually on the back of extremely brisk sales. And so if you take a look what happened prior to 1980, you had a block of 4 years of high sales. 87, 88, 89, big sales. 2000 to 2004 and 5, extremely hot sales. How's our sales this time? Do we have those 4 blockbuster years? Hadn't happened. So you can point to reasons. We have Dodd-Frank, we have lending restrictions, we have things that are preventing our prices from getting to a point where it reaches an affordability breaking point. And that's important information if I'm a real estate lender. If I'm a hard money lender, what do you think we did in 2006? We write a report called the California Crash, and somebody wants to come in and get aggressive with a loan. Would we probably be really conservative and maybe even talk people out of their deals? Yeah, we did that a lot because we thought, you know what, there's almost no safe ground right now. So our loan business probably went down 75, 80% in 2008 intentionally because we didn't want to lose your money. We handed it back to you, and you know what most of the time you guys did? You found another trustee to invest in and lost it on your own. That's what's tough to take. Sometimes it's really the best thing is not to do anything. And that was an odd experience, and that was a crash. California doesn't have very many of those. But sales right now have been really mild. And so when I look at the affordability chart and I look at the sales chart, I don't see that we're going to have an end to this cycle right away. The next thing is California construction. And it's interesting because you get so many different opinions. I can go speak to a group and they'll say, yeah, we're building everywhere in California. And that's why I like charts. Does it look like we're building everywhere in California? Does it look like we're barely building in California? So this is an interesting thing. If you want to have something positive to say, I could take a look at 2011 and 2016, and I could say construction's up 400 or 300%. True statement. But what about historically? How are we doing? We haven't built this few homes from 2016 all the way back until, 1982, when construction interest was 20%. So what does that tell you? Contractors are not feeling aggressive in this market. They don't feel confident. They're not building, they're not constructing, new building lots. How many new building tracts are you passing, waiting to get developed? And because mostly where the vacant land is, you have prices that haven't accelerated enough to where you can even make a profit if you have to start the land from scratch. And so that's the market we're in right now. We have affordability still very high. We have sales that are okay. And we have construction not being a big player in a participation of GDP growth. When we have strong construction, we get migration growth in California. None of those things are clicking right now for California. So maybe they'll come, or maybe we're going to skip a whole cycle. That's entirely possible this time. I'm working on all those things right now, trying to figure out what's next. As you know, that's what I do. Want to take a look at one particular, I'll take first of all, what's going on right now, Vesture Financing. How many of you guys tried to get financing from a bank? Let's say you have 10 loans and you go after the 11th. Is it possible through a standard lender? No, there's a cap. There's a 10 cap, and actually in practice, it really is 4. Fannie Mae has a 10 loan limit, but to get past 4, you have to actually get to a lender that doesn't have an overlay. An overlay means that the lender is being excessively cautious and won't do the 5th one because they fear they might end up buying it back. And so that's really the marketplace. We were asked to go back to Washington, D.C. just about a month ago and spoke to people that are, I really believe this time, going to change the lending policy. So we got to do a presentation coming from a lender's point of view and an investor's point of view about what that would mean and who you're lending to. Because what's really nice about the performance of the people that borrow our money is that it's almost 100% current. That beats Fannie Mae A paper, which is pretty cool. So I show them a $70 million portfolio of our trust deeds, and it's 99% current. And they're just going, what? The interest rates depends on the loan, 6.9 to 9.9 to 11.5, and they have a hard time fathoming that entire group is current. Okay, well, that's an investor. You know, if you deal with investors, that's a different result than a speculator. You know, how you got burned is you lent to speculators who didn't know what they were doing, they didn't have cash flow, and that's a mistake. So don't create a program for that, but do create programs where we can get maybe up to 25 loans or unlimited loans. So we're actually working on that. And we did this about 5 years ago, and I didn't think it would happen. This time I actually think it will. So we got invited back again. I'd go there December 7th to meet with a lot of decision makers for Fannie Mae. And I wouldn't surprise me next year that they actually have a new policy for lending. And I won't take any credit for it because they probably are trying to figure out how to do it with or without me, because I think it's a good business model. One of the things that's going to happen is we're gradually going to go down probably below 60% owner occupancy, owning their own house. It means you're going to have millions of rental properties that are available to finance. And if you're not in that business, that's a mistake. And so I think that's what they're thinking. So the solution up to now has been privately funded loans. And so that's what the Norris Group has done for the last 20 years, is make those loans. Compared to other investments, you know, T-bills, stock market, bonds, I like, all of my money is in either trust deeds or rentals or flips. It's all under the hat of real estate because I understand it. I can control the outcome. I used to own stocks. I hated waking up in the morning and finding the CEO did something bad on Friday night. And then you go, oh, can't wait till the stock opens on Monday. I'm going to get killed. I don't like that. And I also found something about myself. I don't like knowing what something's worth and have it be variable every 5 seconds, because I pay attention to it. Isn't that stupid? Even if it's not even a big pile of money, I'm looking at the computer. Up, down. I don't like that. And I just realized that's not for me, so I don't do that. So trustees, I completely understand what I'm doing. Cash flow is one of the things that most people want. So if you put up money in our trust deed, you're going to get monthly payments. We want every borrower to be reminded every 30 days they have an obligation. You want to get in trouble as a lender? Loan a guy that's a really good buyer unlimited money with no payments. That could get pretty exciting, because at some point it all comes due, and what if he's really good at buying it, no good at fixing it, no good at selling it? That's a problem. So we already know that, so we don't do that. Security, our trust deeds, you have the first trust deed, it's in your entity. We don't pool money. And that's just from experience. Pools work great until they don't. And that's the scary part, is when they don't. They usually are disastrous because you're in trust deeds that you didn't have the option to say, I really don't want a trust deed on 50 acres in Phelan. You know, it just got placed in there because it was a really cool interest rate and seemed safe at the time. So we don't do that. Diversification, So I'm a real estate investor, and I'm a trust deed investor. I get checks from both of those worlds every month. You know which one's the easiest check? Trust deeds, by far. No one calls me with, got a problem, my toilet doesn't work, whatever. I just get a check. Now, it might happen that on the property I have a trust deed, their toilet didn't work, but I don't get a call. I just get a check. And so that's why I like the trust deed world as well. We do research, again, trying to figure out when to be aggressive and when to step back and tell you to do the same. Simplicity of trust deeds, you understand the concept. We've all borrowed money. We understand what a first trust deed is. We probably signed something owing B of A. You're just on the other side of that. You can visit the asset if you want. What typically happens is there'll be a trust process where all of a sudden you think you'll do all these things to check out your own deals, and then you'll find out after a while that we're better at it than you are. And that's a good day for us because you let us do our thing. And that's probably a good idea. We always have people with money in their deal. So they have a profit motive, and they're going to bring money, they're going to hurt if this doesn't work. We want that to be true, okay? There's a false opinion about hard money lenders. And hard money, that's an interesting term. I thought about how do we make that sound softer, nicer. You know what? I don't want to do that. You know what's hard money about it? Isn't it hard to get the pile of money together to be on the other side of the transaction and provide funding for somebody? That's hard. You know what the median cash position is for the retired? The median cash position for somebody over 65? $27,000. The median. Half of all people over 65 have less than 30 grand. That's hard. It's hard to get hundreds of thousands and millions of dollars in a pile and say, I'm going to let you borrow it. That's what's hard about it. And it's just devastating when people are cavalier and play around with it and lose it. Just not fair. So anyway, you can tell I'm really opinionated about that. So we loan to a business guy, and that's the loan that we like. What's going on right now in the Inland Empire is there's projects that you can do from scratch. So one of the loans we would do, or one of the projects we would be involved in, would be a new construction. There's a sheet that you have, you don't have to look at it this second, but there's a sheet that with the hard money loan programs is a breakdown of the costs of this particular project. This is a home that we just built. 4-bedroom, 4-bath, 2,750 square feet. It was on a kind of a hilly lot. And there was, are you ever involved in a project that has more excitement than you thought would have? Like about 100% of the time? Has anybody ever heard of the term called blue rock? Uh-oh. Blue rock is hard. Harder than anything that you could imagine. The only way to break it apart is to get dynamite, which is unpleasant for your neighbors. They don't want you to do that very often. And so we got a few dynamite explosions out of the way, and then we didn't get to do that anymore. So this lot had blue rock. What do you do with it? Well, as a matter of fact, there are people that have need use of gigantic boulders and projects that they have, and they came and they took it all away. Can you believe that? Whew. Every project's got the excitement, though. So this is a brand new house in Riverside. The lot cost was $85,000. We usually try to get our building lot at about 20% of after finished product. If you pay too much, and of course that's going to vary. You could be in Orange County where the lot's going to be 60% of the value, but in our Inland Empire, if we're at 20%, we feel pretty comfortable. We just bought 2 more lots at about $65,000 for a $350,000 house. So that still follows in place. So we have about 6 of these projects going on right now. A builder, in this case, we don't loan to him, we partner with him. The advantage for him is he doesn't have a hard money loan payment. So he comes to us with the project. We dealt with him for a long time. And so he comes to us and said, we got a 475 finished product. Here's the numbers. And at the end of the day, we should make about $85,000, I think, was the projected on this. One of the nice things that happens in California is every once in a while you do it in a cycle where the price goes up. So the price was not what we thought. It wasn't 475, it went to 550. So we closed at 550. So we got a 75 extra bonus check, part of which we gave to the Blue Rock project. But that's part of why you want to do it when you're supposed to do it. I've been on the other side of that. Actually, isn't it interesting? 550 on those Palm Springs houses I mentioned, 550 was the projected price of that. You know what I closed the last one at? 360. Just a tad light, as they say. I had to actually bring in a personal check to close that, 62 grand to protect my partner. That's called a personal short sale. And you remember those really well, as in, I don't want to ever do that again. Okay. Now, had we done a hard money loan on this project, if we had an anticipated sale price of $475, we would probably do a 60% loan or $285 gross loan, charge points and fees of $67.95. We would have a fund control set up, and a fund control it's necessary and actually mandatory, but it's really important because they follow the project and do all the paperwork necessary, do tons of pictures before we release any money. So we're never ahead of the curve in a construction loan. We're always way behind the curve in the sense that you have money out, work out ahead of us to where if something goes wrong, we can finish this house and not going to be a big deal. Monthly payments on that would be $28, $26. So you can imagine if instead of having a partner on most of these things, he did loans. If he did 6 projects, he'd be having payments of like 16 grand a month. So sometimes it's preferable to share the profit and have a partner. If he holds it for 6 months, then he has a cost of $16,957. So if you figured out all that, he would probably end up with more profit on this deal if he soloed it, because he would be paying the points and the cost. But again, it's easier for him just to be able to find the next profitable project and access a partner. So that's a good arrangement, for us and for him, and it's something that you can replicate with somebody that you trust. So he brings all the skill to the table, and we bring the money to the table, and we split 50-50. I'm so comfortable with him. I honestly never even see the project at any stage during it, ever. Sort of like most of you who trust deeds with us, I bet you have most of your money on first trustees on properties you've never seen. And you wouldn't do that if we didn't earn that right. And I wouldn't do it if he hadn't earned the right. Because that's ultimately what's nice. Aaron, he's been in business for 35 years. Most of the business that I've done has been with repetitive people for a long time. And the reason that is I already know what to expect. And I also have been through some tough times with most of them, and I know what to expect during tough times. That's the hardest thing, is everybody telling you how good they are. I've never had anybody hand me their business card and say, when things get tough, I usually get shady and I split. They don't give you a warning system on that one, but it does happen, okay? So sometimes when you have experience with somebody and it hits the fan and they're still there, you go, I like this, this is nice. Okay, now this is another type of transaction, and we're going to talk about 1031 exchanges today. So a 1031 exchange has a clock attached to it. I sell something, I have 45 days to say I'm going to buy that, and 6 months, inside of that same 6-month period, I have to close it with the money that came from my sale. So this is what this transaction was. There was a purchase price of $251 on something that was worth $307. So it's probably not the most exciting deal if you were flipping it, but it's a decent deal if you're exchanging it and you're going to keep it. So you already have a 50% or $50,000 equity position, and the money that came from the 1031 exchange is 190 grand. So our gigantic loan amount is 65. So if you had a 65 grand trust deed on that, would you worry about? No. By the way, we don't hope anybody doesn't make their payment. None of our trust deed investors are in the league of, I hope they mess up so I can get their house. It's just not why trust deed investors do what they do. They just want a boring check every month. I do. I don't want the excitement of a foreclosure. I just don't. So, but that's sometimes what happens is in a 1031 exchange, you have all this money has to get spent on a house, and so it leaves very little. Or he may have owed $65,000 on the house that he sold, and he has to replicate that debt. But I'm not going to speak to you about 1031 exchanges today. It's kind of out of my league. By the way, we have never done this event that I haven't learned something every time, which is kind of cool. After being around, yes, 35 years, Aaron. Back there, I've learned two things today that I didn't know. Both things I'm involved with right now. Carn Hall mentioned one of them, and then the tax gentleman mentioned the other one, and I thought, wow, I'm so glad I'm here today, because I didn't know those things. Okay, so who uses hard money? We have people that keep rentals. We have the 6.9% program where they're going to keep that. We have that for a 3-year program right now. We have people that are flippers. So these deals are usually at 8.9%. They put 20% down or more. They buy the houses. Usually they're buying them and they're in rough condition, and they fix them up or they expand the square footage. There's all different kinds of ways that they find these properties. They do mailers. What they're not usually doing nowadays is buying REOs or short sales, because that's all diminished. So they're going out and hustling each one of these deals one at a time with mailers, or you might drive by and see signs, we buy houses, or they have websites. So that's the techniques they use to get people to call them so they get a chance to buy. We loan to builders, and already went over one of those projects. Interestingly enough, the worst person that you can loan to in the hard money loan business turns out to be the owner-occupant. They've pretty much made it illegal, so we couldn't do it anyway, but we wouldn't want to if we could, because who our borrower is a business person who intends to make a profit. And when we lend them money, one of the things that Craig makes sure they have is a reserve. Because blue rocks happen, right? Every project has its surprise. And we want to make sure that we've got lots of coverage for payments and the surprise on each project that somebody does. If a owner-occupant borrows money at 11% in this market, what does that tell you? We're their only option, and they're solving yesterday's problem with today's new money. When we fund that loan, they may sop up all their problems in the past, and now they have a big payment on top of whatever wasn't manageable before. That's going to not work out a lot of the percentage of the time. We just don't want to do that. And the law's pretty much made it now where it's really hard for them to get money. So there must be a happy medium, but if you called us up right now and you have a $200,000 house free and clear and you need 30 grand and you live in it, the answer is no. We wouldn't do it. One thing that's interesting, and we have a radio show. Aaron, what's the name of the program where you can do repairs on the house? And it's through the city, and they don't have to appraise it, they don't have to qualify for it. It's just for the HERO program. So the HERO program is something that we have to be aware of. How many people understand what the HERO program is? Okay, so you've got a home and you want to do energy efficient roof, and you're 99 years old and you own the house free and clear and you have $300 a month income. You can borrow against your house up to a very high percentage loan to value and do repairs on it without qualifying. And the really scary part is it becomes senior to any other existing trust deed. That's pretty uncomfortable. And I think they're trying to work that out to where that stops happening, but it's still it still would exist. So you could have an existing first trust deed, and they could borrow money on the HERO program and become senior debt because it acts like property tax. That's the nature of the bill, okay? Okay, they changed the rules for who could invest in trust deeds. There's something called suitability. So what if you had all the money in the world, but you had no idea what the heck a trust deed was? We have that happen sometimes. We'll have people come and say, I just got a settlement, or my grandfather died and I got $3 million, you know, and we want to give it to you guys. Do you know what a trust deed is? No? Would that be a suitable investment for them? Not yet. We can't do that. You know, we'd have to make sure they really understood. So there's times where it's not suitable. There's other times where now there's a 10% rule that says that if you're going to make a loan, say $200,000, you have to have a $2 million net worth. You can't loan more than 10% of your net worth, excluding your residence, to anybody on a trust deed. So it really eliminated a lot of very small people. So that $65,000 loan that might be very easy for somebody to make out of their 401k or their Roth IRA, now they have to have a net worth of $650,000 or they can't do it. So some of it was overkill, and maybe some of it was steering to whatever other investment they would rather you do. I'm not sure. There's a questionnaire that we ask everybody that's going to invest in a trust deed to fill out, and it will give us the numbers that we need to go forward on a particular trust deed. Why work with a broker? You know, in this particular world of lending, I would not put my money directly with somebody without a broker's involvement, because there's rules that you can cross over, and there's bad people trying to borrow your money sometimes. And I've seen it. Sometimes when we get slow, we have to hand back investors' money. And then I'll talk to them later and they say, oh, it's no big deal. I've lent the money out directly to people. Great. What'd you loan on? Oh, I got a great return. I got 16%. You know, I'm cringing. Okay. Yeah, it's a third on a piece of dirt. You go, oh boy. You know, just kiss that by. I mean, when you chase yield, or you make mistakes, you can pay really bad for that. A broker is like a clearinghouse for all this stuff, okay? So first of all, paperwork gets updated all the time. So we have software that's very expensive that we have all that stuff. And we're a deal magnet in the sense that our phone rings all day long. Craig fields phone calls. One of the interesting things, how many of you have invested in trust deeds with us? I'm just curious. Okay. You have no idea how many times Craig says no in a day because it's not the right thing. It's not the right mix. Somebody calls up, you know, and I get this when I'm speaking. I'll be in front of an audience and somebody come up, I found my first deal. That's great. I got a $60,000 deposit on it. That's wonderful. Tell me about the deal. He says it's on a hillside. It's got foundation damage. I said, how many of those have you fixed? This is the first one. First project period, yeah. Can you get your 60 grand back? First of all, I said, how many 60 grand chunks do you have in your life? He said, just one. I said, can you get it back? He said, yeah. I said, get it back. That's the calls we say no at. And pretty quickly, you know, that's pretty easy. And didn't we just help that person, by the way? That's not where you start over your head. You know, you're gonna stub your toe really bad. We don't want to participate in that. We want to tell you, get the heck out of there too. You don't belong there. You're not ready for that project. Now, if somebody comes to us and that's their niche, I mean, that's all they do is foundation damaged houses, you know, we might have a conversation, but they'll have some serious money in that deal, because if it goes bad, it's not going to go bad for our side. So a broker has earned the right to get all this input, and then we, you know, field it all and say, okay, this is the good stuff that's left. Again, same thing. We do our detective work, and we make sure that when we call you, we actually have something that makes a lot of sense. Why the Norris Group in particular? We have the ability to look forward and say, this is a risky market, so we're going to act very cautiously, or we feel that we're very comfortable with the market, and we can go on as we are. team with over 100 years experience. That's just scary, isn't it? We do have a lot of very experienced people, and I don't know how to explain sometimes what happens, but it's important to have someone there, the hair goes up on their neck for some inexplainable reason, and then you turn out they're right. And that's happened more than once at the Norris Group, where there's just something about a transaction, even though it looks all fine in black and white, and then you go, you know what, I'm really uncomfortable with this, and I can't exactly say why, and then you find out there was a falsified grant deed to get to this person that they wanted to refi, and it was all nonsense. And you're really glad you have some experienced people that just have that in there somewhere, because they've seen thousands of them that are right. They get the sense of when something's not, and so that's important. Probably the best compliment ever. Mike Cantu is a very well-known investor. He's probably flipped himself a couple thousand homes, been trained by a lot of people. He likes to go to seminars. I don't think he needs much more training. But I asked him one time at lunch, I said, can you give me, I want you to think about it, give me a word that you would attach, like a brand, to everyone that's taught you, Ron LeGrand, Miller, the Norris Group, everyone that you're involved with. And so he thought about that for a couple days, and he called me back. He said, it's interesting, everyone else has a real estate definition, except for the Norris Group. He says, you have integrity. He said, I would play high-stakes poker on the phone with any one of your employees and get told my hand was beat, and I would send a check, and I would never think twice about it. I thought, wow, that's pretty cool. So we've taken time to be with the right people. We build long-term relationships, and it's a gradual process, whether you're a trusted investor or you're a flipper. We get used to you, and you get used to us. We go slow at first. We don't want somebody to put all their money in their first month. They go, okay, wow, no, that's not what we want to do. We want to make sure everybody goes through a process where we know each other, we know what to expect. So again, all first trust deeds and no pools. So you're in charge of making the decision. And that's when it happens that you have a problem and you're in a pool, you have no decision making, by the way. There's a new thing, and we haven't really talked about this. How many have heard about crowdfunding? Okay. I was going to be on a panel with somebody that was involved in crowdfunding, and so I really took time to read their document with a yellow marker, like I am known to do. And in this particular company, and I don't even remember the name of it, you didn't own a trust deed, which was really interesting. You owned the right to the cash flow of that trust deed, but you didn't own the trust deed itself. It said that in the event of a non-payment, you would not have the right to foreclose on the property because you don't own a trust deed. And your cash flow just merely ceased. And it also went on to say, and this was yellow marked at least twice, is that we are staffed to do loans primarily, and we may not have the time to pursue a foreclosure. Wow. I was going to be on the panel with this guy. It didn't happen. But he would have had some hard questions because I would have pressed that so everybody understood that this is not a normal trust deed investment. So you have to be really careful if you're getting involved in crowdfunding to read the document really carefully, because you may not own what you think you own, okay? What you're really doing is you're making a startup company an unsecured loan. That's what it amounts to, and you are the last creditor in line, at least on that document. Okay. How about we open for questions? We only have 3-4 minutes. Aaron, you going to get a mic? Okay. No questions. Yeah. Yeah, February will be a very sizable report, and kind kind of take a look at the next 10 years, to be honest with you. Probably the last report I'm going to write. That'll be the 10th report. And so I'm going to take a long view of what I expect to happen. I literally have 5 books on my desk that are probably 400 pages long that I have yet to read. I've done all the chapters that are fairly easy, and the next 5, oil, China, Eurozone. I have to study that stuff from scratch because this time I really think that stuff impacts what happens to us in California real estate. So I have to get my hands around that, yes. I think it's probably a really loud background noise for either win. I don't see cohesive outcome. And that's disturbing because we really have some tough decisions to make and we're not going to be capable of making them. And that's what's really frustrating. We need a spirit of cooperation, and if side A, side B, I can't see that happening. It's really sad. So that's one of the bigger concerns, that we're not going to get to solve our problems. Yes.
Yeah, Bruce, I was at the Nixon Library a couple of weeks ago, and you made just a passing comment that you were moving some of your money from California to Florida.
Yes.
If I understood that correctly, could you comment on that?
Sure. It's not because I'm afraid of the California market. It's because my best friend lives in Florida. I was interviewing the chief economist from Fannie Mae in the first quarter of 2015 to do research for that interview. I read their quarterly report and found that 25% of Fannie Mae's losses came from one state, Florida. So I know something has to be on sale in Florida. My best friend lives there named Alex. I've done business with him for 30 years. Again, I already know what to expect. I called him up. I said, Alex, poke around, find us a tract of building lots. There has to be somebody that has lots they don't want. So we found a tract of building lots, bought them for $13,000 a piece, in a very nice little area, and we're building a tract of rentals. And so I've 1031 exchanged some of the money to own those things because I can exchange one house for 2 houses there, built in the 80s, brand new houses. It's a no-brainer decision. It has nothing to do with me being concerned about California market. It just has to do with me setting up my retirement in a way that I'm happy. So, hope that answers. Yes.
My name is Tim Clayton. I first started investing in hard money with the Norris Group in 2008, and it's been a wonderful experience. Thank you for letting me be part of it. I think we've done over 100 loans, and it's just been nothing but wonderful.
Thank you very much. Really appreciate that. By the way, do you see properties that you loan on now? I'm just curious. Yeah. Do you go see any properties that you loan on?
You know, at the beginning, I looked at everything we were doing. I've never seen one property, like maybe one, because it was close to where I live, but I've never looked at them.
Okay.